Here's the number one question flooding my inbox right now. Is XRP dead? Is it going to $1? Is this war going to wipe out everything I've built? And I get it. Because right now, if you turn on the news, it looks like the world is on fire. Literally. US and Israeli strikes killed Iran's supreme leader. Tankers are burning in the Strait of Hormuz. Dubai and Abu Dhabi shut their stock markets down. And analysts are throwing out numbers like 0.85 XRP, sub-dollar XRP, and worst-case altcoin wipeouts. But here's the thing. While the crowd is panicking, staring at red candles, and rage posting on X, there is a completely different story unfolding underneath the surface. One that mainstream financial media isn't explaining to retail investors the way it should be, because this war, as devastating as it is, may be the very event that permanently separates XRP from every other altcoin in existence. And in the next minutes, I'm going to show you exactly why. Welcome back. I'm Crypto Regency. This channel exists for one reason, to cut through the noise and give you the kind of analysis that most retail investors never get access to. We don't do hype, we don't do panic, we do data, structure, and the math that moves money at the institutional level. Today, we're breaking down the Iran conflict, what it actually means for global financial infrastructure, why the Strait of Hormuz situation is the most underpriced macro event in years, and what smart money is doing with XRP right now while the crowd melts down. Let's get into it. Let me start with the hard truth that nobody in the mainstream crypto space is saying out loud. 90% of investors are looking at this war and asking, how far does XRP drop? The right question, the one institutions are asking, is, what does a global settlement crisis do to demand for instant, liquid, cross-border infrastructure? Those are completely different questions, and the answer to the second one changes everything. Here's what you need to understand. The global financial system, right now, today, moves trillions of dollars across borders every single day through a network of correspondent banking that is slow, expensive, and fragile. We're talking about $27 trillion in Nostro Vostro accounts sitting dormant in banks around the world. Dead capital. Locked up as collateral just to make international wire transfers work. In normal times, that's inefficient. In war times, when Gulf banking hubs like Dubai are under threat, when insurance on tankers just jumped 50% overnight, when energy prices are spiking and every major trading desk in the world is scrambling to manage currency exposure across 6 time zones simultaneously. That system doesn't just become inefficient, it becomes a liability. And this is what most retail investors are completely missing. The more the traditional financial plumbing is stressed, sanctions risk, currency volatility, disrupted trade routes, the more pressure builds on institutions to find an alternative, a bridge, a neutral, instant, programmable settlement layer that isn't tied to any single country, any single central bank, any single correspondent relationship. That's the role XRP and the XRP ledger were specifically engineered to fill. David Schwartz, Ripple's CTO, has been saying this for years. The legacy correspondent banking system wasn't built for a world where geopolitical risk can freeze your capital flow in 48 hours. It was built for a stable, globalized world that increasingly no longer exists. So yes, in the short term, XRP is going to face selling pressure. Risk-off moves hit altcoins hardest. Middle Eastern institutional holders are going to de-risk. We've already seen a 7% sell-off this week. That's real. That's happening. But zoom out. Because what this moment is actually doing, if you're willing to see it, is building the exact case for why XRP's long-term function becomes more critical, not less. Let me do the math the retail crowd ignores. We're talking about a war scenario that, in the bear case, could push oil to $120, maybe $150 per barrel. The Kobayashi macro letter that circulated this week put out a projection. If the Strait of Hormuz experiences sustained closure, US CPI spikes to 5%, maybe higher. What does that do? It kills rate cuts, it potentially forces emergency rate hikes, and that is the scenario where you see a real liquidity crunch, where capital rushes toward hard assets, toward dollar-denominated treasuries, toward gold. And yes, everything else, including crypto, gets sold, I'm not sugarcoating that. If we hit that scenario, the models analysts are running show XRP testing 1.0, possibly 0.85 in extreme capitulation. That's on the table. Be honest about it. But here's where the math gets interesting. Right now, the total notional value of the global derivatives market is approximately 1.2 quadrillion. Cross-border payment flow is $150 trillion annually. Daily Forex volume alone is $7.5 trillion every single day. Now ask yourself this question. How much of that flow is currently exposed to geopolitical disruption? How much of it runs through banks in the Gulf? How much of it is delayed, frozen, or rerouted because of the Hormuz situation right now? If even 1% of global cross-border payment flow migrates to on-demand liquidity infrastructure over the next 36 months, not because people love crypto, but because the legacy system literally can't handle the stress, that's $1.5 trillion in annual transaction volume looking for a home. XRP's total circulating supply is approximately 56 billion tokens, not 100 billion, not unlimited like some other projects. 56 billion, with 44 billion still locked in Ripple's escrow, mostly relocked month after month. Here's the math that matters. At current usage levels, exchange reserves for XRP have been trending toward multi-year lows. On-chain data from CryptoQuant shows consistent outflows from centralized exchanges, which historically means accumulation, not selling, accumulation. At a 135 price, XRP's market cap is roughly $75 billion. To bridge even a fraction of the $27 trillion in dormant Nostro Vostro capital, XRP would need to be orders of magnitude higher in price, not because of speculation, but because of liquidity physics. You need enough value in the token to act as a meaningful bridge without requiring the system to hold enormous quantities of it. This isn't a prediction, it's a design requirement. If you have a problem with those numbers, you don't have a problem with me. You have a problem with the math of how settlement infrastructure works. Now let's talk about what smart money is actually doing right now, because it is not what you'd expect given the headlines. While retail investors are panic-checking their portfolios and posting doom threads, let's look at what has been happening in the background over the past 60 days. Ripple completed its acquisition of Hidden Road, a prime brokerage firm that clears over $3 trillion in transactions annually. $3 trillion. That is not a company you buy if you're preparing for XRP to go to zero. That is a company you buy if you're building the rails for institutional-grade, compliant, high-volume settlement infrastructure. Ripple also recently expanded its presence in key markets, including the UAE, which, yes, is currently in the headlines because of the war. And that matters, because the UAE is one of the largest financial hubs in the world. And the fact that Ripple deepened its footprint there before this conflict tells you that the architects of this system were building for exactly this kind of stress scenario. Ask yourself, does a company that has survived a multi-year SEC lawsuit, built correspondent banking relationships in over 40 countries, and is now acquiring institutional infrastructure, does that company make those moves without absolute certainty about where this is going? The answer is no, they don't gamble, they position. And then look at the broader institutional signals. The Digital Asset Clarity Act is moving through Washington. After years of regulatory ambiguity, years of is XRP a security, is it not, we are entering the final phase of legal framework construction. Analysts tracking this legislation are reporting bipartisan support in committee. That's not nothing. In a war environment where inflation pressures are building, where the dollar's role as the sole global reserve is being debated at the IMF, the push for compliant digital settlement infrastructure accelerates. It doesn't slow down. Even Federal Reserve commentary this month has subtly shifted. The language around central bank digital currencies and programmable settlement has become more frequent, more detailed, more precise. Jerome Powell doesn't talk about infrastructure he's not preparing for. BlackRock, Franklin Templeton, Fidelity, these entities do not enter a space and then disappear because of a 2-week geopolitical shock. They are in crypto infrastructure for the long-term structural shift. The question was never if they'd need digital settlement rails. The question was always which rails. And while I'm not going to sit here and tell you that's definitively XRP, I will say this. The XRPL is the only blockchain with a built-in decentralized exchange, cross-currency payment pathways, and the regulatory track record to operate under compliance frameworks in the US, EU, Japan, and the UAE simultaneously. That combination of features doesn't exist anywhere else. The signal is clear, but only for those who are actually looking. Let's talk about what comes next, because timing is where most investors lose the thread. In the near term, we're talking the next 30 days, this market is going to be driven by geopolitical headlines, not fundamentals. Every time there's an escalation in the Hormuz situation, you're going to see sell pressure across crypto. Every time there's a signal of de-escalation or a diplomatic move, you'll see sharp recovery bounces. We saw this play out in real time when Bitcoin dumped to 63Ks on the strike news and recovered to 67K within hours. XRP will underperform on the downside moves. That is historically consistent. Altcoins absorb more of the risk-off shock. But XRP has also historically overperformed on the relief bounces because the fundamental narrative is intact. The medium-term catalysts, Q3 and Q4 of this year, are where it gets structurally important. The Digital Asset Clarity Act is expected to reach a floor vote by summer. If that passes, or even if substantive progress is made in committee, you remove the single largest institutional barrier to XRP exposure in the US market. That's the gate that's been holding back a wave of capital that has been lined up, waiting, positioned, just needing legal cover to deploy. Simultaneously, the war's economic damage is going to force a policy response. Either oil prices come down and the Fed gets back to cutting rates, which is historically rocket fuel for risk assets, or the prolonged inflationary pressure forces a crisis that accelerates the entire global financial system's pivot away from fragile fiat-based correspondent banking. Both of those outcomes have a path that runs through compliant digital settlement infrastructure. And then, specifically for XRP, Ripple's ODL, on-demand liquidity, volumes have been quietly growing in corridors that the mainstream press isn't watching. Southeast Asia, Latin America, parts of Africa. These are the regions most exposed to currency volatility from a prolonged Middle East conflict. And those are exactly the corridors where XRP-based cross-border payments offer the most immediate, tangible cost savings. The window is narrowing for people to position before these catalysts stack. Here's what most people don't think about during a crisis period. This is when the accumulation actually happens. The retail crowd is looking at 1.35 XRP and thinking about 0.85. The institutional accumulation models are looking at 1.35 XRP and thinking about the 56 billion token circulating supply and what happens to that price when $100 million in institutional demand enters a thin market. Let me be clear about something. Crypto quant data shows that XRP exchange reserves, the amount of XRP sitting on centralized exchanges available for immediate sale, have been declining. Not spiking, declining. That means even in this environment, there is net outflow from exchanges. That means holders are moving XRP into cold storage, into custody, off the market. In supply and demand terms, you have a fixed supply asset, 100 billion total, forever, no inflation, with declining available sell-side liquidity and a macro environment that is building a multi-year structural case for exactly the utility this asset was designed to provide. The people who accumulate in the fear are the ones who are positioned for the breakout. And the breakout doesn't announce itself. It doesn't give you a second chance to buy at these prices. History shows that assets tied to real utility don't bottom and then slowly recover. They bottom, consolidate, and then move violently, usually triggered by a catalyst that seemed obvious in hindsight, but was completely invisible in the panic. The war itself may be that catalyst on the other side. A ceasefire, a diplomatic deal, an agreement that contains the Hormuz situation. And suddenly, the macro overhang lifts, and all the capital that's been on the sidelines looking for entry flows in simultaneously. One is chaos, the other is the blueprint playing out. The question is, are you watching the noise or are you watching the structure? Now let me address the bear case honestly, because I think you deserve a full picture, not a sales pitch. The realistic downside scenarios are real. If the Strait of Hormuz sustains a prolonged blockage, weeks not days, and oil hits $120, $130, $150 per barrel, and US CPI spikes toward 5%, the Federal Reserve's options narrow significantly. Emergency rate hikes in that environment would be catastrophic for equity markets, for tech stocks, for crypto broadly. The cascade scenario that some analysts are mapping out, margin calls, liquidity crisis, Bitcoin below 30K, altcoins down 70 to 80%. That's not impossible. Be honest with yourself about that. The political dimension matters too. This conflict was launched without full congressional authorization. The Gang of Eight were notified, but Congress was not given a formal declaration of war vote. That means this operation exists in a legal gray zone domestically, which creates unpredictability around how long it can be sustained and what the political blowback looks like heading into midterm elections in November. Republicans have a tight margin. A prolonged, expensive, inflationary war doesn't play well with the electorate they need. President Trump came into office with 3 explicit promises: be a peace president, eliminate inflation, and get gas to $2 a gallon. A sustained war with Iran runs directly counter to all 3. That political pressure may actually be the most powerful force toward de-escalation. Not military calculus, not diplomacy, but pure domestic electoral math. And for XRP specifically, the Binance Iran investigation that senators are pushing creates regulatory noise at exactly the wrong time. 11 senators urging Treasury and DOJ action on potential sanctions violations. That kind of scrutiny creates overhang on the entire crypto asset class, not just Binance. So yes, the risks are real. Sit with that. Plan for it. But here's the reframe. Every one of those risks is short to medium term. Every one of the structural catalysts for XRP's utility and adoption is long-term, and in every prior geopolitical shock in this market, from COVID to the 2022 rate hike cycle to the FTX collapse, the assets with genuine utility and institutional backing recovered faster and moved higher than assets held up by speculation alone. That's not hope. That's the pattern. Let me bring this home. Here's where we are right now. The world is facing a genuine geopolitical shock. The Strait of Hormuz, a 33-kilometer choke point carrying 20% of the world's oil, is under threat. Markets are pricing in a contained conflict. If that's wrong, the downside is severe and broad. If it's right, the recovery will be sharp and fast. For XRP specifically, the near-term pressure is real. The 120 level and even 0.85 are on the table in a worst-case scenario. I'm not going to pretend otherwise, but here's what I want you to walk away with today. The same forces creating the chaos, geopolitical fragility, correspondent banking stress, currency volatility, a world that can no longer rely on stable, centralized financial infrastructure, are the exact forces that make XRP's core utility case stronger, not weaker. The institutions building on XRPL know this. The regulators drafting the Clarity Act know this. Ripple's acquisitions of prime brokerage infrastructure know this. They are not building for the world that existed 3 years ago. They are building for the world that is being created right now. The retail investor who sells XRP at $1.20 because the headlines are terrifying and then watches it move back to $3, $5, $8 over the following 18 months as the regulatory and macro environment stabilizes, that investor will tell themselves they couldn't have known, but you will have known, because you're watching the structure, not the noise. History does not reward comfort. It rewards those who pay attention when the room is quiet. Stay patient, stay rational. Watch the Hormuz situation carefully, not because it determines XRP's long-term fate, but because it determines your entry window. I'll be back as this develops with updates the moment the macro picture shifts. If this kind of analysis is what you come here for, subscribe and hit the notification bell, because the next 30 to 60 days are going to move fast, and you need to be ahead of it, not behind it. Comment structure below if you made it to the end and you understand what we just broke down. Knowledge is the only hedge. Stay sharp, stay positioned. I'm Crypto Regency. And as we always say, we don't wait for the future, we plan for it.